My top 10 rules will ensure you live a financially secure and independent life. I've spent 35 years in the banking, wealth management, and insurance businesses, and now teach personal finance at a local university. I know the tricks banks use to convince you to choose one financial product over another, many times not in your best interest. I have seen people earning $300,000 per year fall into financial despair, and others earning $70,000 per year become financially secure with a well-funded retirement plan. The amount you earn in a year has less to do with becoming financially secure than smart personal financial management. These rules are easy to understand and follow. So let's get into it now. The number one rule is to create a budget and manually update your spending at least once per month, ideally twice per month each time you get paid. Use Excel, a spreadsheet, or pen and paper. Do not use an app or software that automates the population of your spending into your budget. It is important for you to understand what you are spending and where. Look at your bank and credit card statements and update your budget continually. If you do not know how much and where you're spending your money, the rest of your finances will fall apart. Follow the 50-30-20 budget method. I have another video that explains the 50-30-20 budget method if you are not familiar. Number two, understand how your medical and dental insurance plans work. Document your copays, deductibles, and coinsurance limits, as well as your maximum annual out of pocket amount. These numbers change each year, so to be sure to update your notes annually. Medical debt is the second highest reason people file for bankruptcy. Build your HSA balance up to your annual out of pocket maximum, even if this will take you 3 to 5 years. If you are not in a high deductible plan, put 75% of your typical annual medical expenses into an FSA. Both of these plans, an HSA and an FSA, will lower your taxes. Taxes act as a cancer on your income. Number three, spend 30% or less of your monthly net income on housing. The 30% is inclusive of any HOA, property taxes, and insurance. If you are a renter, I always recommend renter's insurance. It's not very expensive and may save you from financial ruin. If you are spending more than 30%, consider downsizing or getting a roommate or a boarder until your income catches up. For some of you, 30% seems like an out of reach goal. Even if it takes you several years to reduce the cost of rent relative to your income, no other step will impact you more than this. Shop your homeowner's insurance every 3 years or whenever it is raised more than 4%. The insurance company or insurance agent you think is loyal to you probably is not. They are loyal to their own bottom line. Number four, manage your recurring utility costs through thoughtful conservation. Monthly electricity, gas, water, sewer, and even garbage collection combined are a large cost on your budget and can be lowered slightly with thought. If your utility offers a smart thermostat or an energy conservation plan in exchange for a monthly discount, take advantage of it. It is better to be warm or cold a few days of the year than to let these expenses impact your chances of financial success. Number five, never pay a credit card annual fee. The benefits you think your credit card annual fee is affording you are rarely realized. There are many no annual fee cashback cards paying 2% cashback or more on all your monthly spend with no categories or spend caps. Choose cashback over miles or points. Miles and points earn and redeem formulas can change and often do. Number six, finance your vehicle with a 60-month or less auto loan and never lease. Leasing will force you to pay monthly for your vehicle indefinitely. With an auto loan, you can make extra payments and eventually rid yourself of interest costs and this high monthly expense. Put at least 10% cash down when you purchase a vehicle. If you can't afford to put at least 10% down, choose a less expensive car or wait until you have saved the down payment amount. A down payment will ensure if your car is totaled in an accident or stolen, you will get enough money from the insurance company to pay it off. Number 7, never carry a balance on a credit card and minimize your consumer debt. If you have credit card debt today, make a plan to pay it off in the near future. Strive to pay off all your student loans by the time you turn age 35. Use cash to pay for cars after age 50 and strive to have no mortgage by age 65. You have 3 savings goals, and the order in which you fund them is important. Your first goal is to build a rainy day savings balance. Save 3 to 6 months of your net income, 1 month for each month you expect it will take you to find a new job, but at least 3 months. You may think getting laid off from your current company or your current company going out of business is not a possibility, but it happens every day when we least expect it. Keep this money in a liquid bank or brokerage account. If your bank is paying less than half of what you could earn in a money market mutual fund, find a new bank. Never keep more than the value of 2 paychecks in your checking account. If your bank is unwilling to invest in you with a competitive interest rate, why invest in your bank? Your second savings plan is to create a plan to fund your retirement. A good rule of thumb is to have 1 times your annual salary saved by age 30, 3 times your annual salary saved by age 40, 6 times your average salary saved by age 50, and 10 times by your retirement date. Always contribute to an employer-sponsored 401k or 403b plan up to the maximum employee matching amount, but never less than 5% of your gross salary. Increase your contribution amount by 1/3 of each raise you receive until the maximum allowed by the IRS is reached. If you get a 3% raise, increase your contribution amount by 1%, a 6% raise, then 2%, and so on. Number 10, and the final personal finance rule, fund your children's college savings using a 529 plan or help your retired parents financially, but only after your first 2 savings goals are met or on track. We all love our children and parents, but if they won't pay for our retirements, who will? Thank you for watching Dave the Personal Finance Professor. Subscribe to my channel for more tips you can use to achieve financial freedom.